Subscribe to my channel Report Stock.
All right, let's get into it. Welcome to the deep dive. Today, we're cracking open the latest from TD Bank, their Q3 2025 earnings call. Forget the headlines. Our job is to dig through the reports, analyst notes, and that leadership Q&A to pull out what really matters for you. What we've uncovered is a truly compelling picture. Yes, impressive financial muscle, but also some, serious strategic shifts and big bets TD is making on the future.
It's a fascinating tightrope walk, isn't it? For a financial giant like TD, the challenge isn't just about posting strong numbers this quarter, but simultaneously laying the groundwork for competitiveness years down the line. We'll show you how they're managing that often conflicting dynamic, balancing immediate market expectations with, well, some costly long-term transformations.
Absolutely. So let's start where everyone's eyes went first, those headline numbers. TD's Q3 2025 earnings landed at a robust $3.9 billion with an earnings per share, or EPS, of $2.20. And perhaps even more telling, a really impressive 10% year-over-year revenue growth. But the real standout for me was their positive operating leverage. This isn't just jargon. It means they grew revenue faster than their expenses, a clear sign of efficient, disciplined management.
Right. And that efficiency isn't just a lucky break. It's intricately linked to their strong capital position. That 14.8% Common Equity Tier 1, or CET1 ratio is, well, it's like a strategic goldmine for TD. It positions them as one of the best capitalized banks globally, granting them enviable flexibility. They can either weather significant economic downturns or pursue ambitious growth opportunities without immediate capital concerns. That's a luxury many peers simply don't possess.
And it's not just about building up that capital. They're also actively returning value to shareholders, repurchasing 46 million shares totaling over $4 billion in Q3 alone. So if we're just looking at the top line figures and capital strength, this was, a very solid quarter.
If we connect this to the bigger picture, these numbers collectively paint a clear picture of TD's fundamental strength and resilience.
Yeah.
In an unpredictable economic environment, this robust capital base isn't just about stability. It's the engine that fuels both their strategic defensive capabilities and their capacity for future growth initiatives. It's truly a foundation for both weathering storms and, seizing opportunities.
Okay, that's the big picture. Now let's zoom in on some specific areas where TD is not just holding its own, but showing some real strategic wins and forward-thinking moves. In Canadian personal and commercial banking, for instance, we saw a healthy 4% year-over-year loan growth, and their net interest margin, or MENIM, was a solid 2.83%, actually ticking up 1 basis point quarter over quarter. That's steady performance in a mature market.
That steady growth in Canada underscores the reliability of their core operations, but it also, highlights the challenge of finding high-growth opportunities there.
Which makes their U.S. strategy all the more interesting.
Right. Here's where it gets really interesting and, frankly, a bit of a strategic bullseye. Their U.S. retail segment progress. Core loans were up a respectable 2% year over year, but U.S. bank card balances absolutely jumped, an impressive 12%. This isn't just general expansion. It suggests TD is pinpointing high-growth, high-return areas in that crucial competitive U.S. market. That could be a significant competitive advantage.
Absolutely. That 12% jump in bank card balances suggests, well,
Aggressive, successful customer acquisition and engagement in a highly lucrative segment.
Yeah.
It speaks to a targeted strategy that's translating into tangible results, beyond just broad loan growth.
And beyond traditional banking, TD is also making some serious forward-looking investments in technology. They specifically highlighted the launch of innovative AI tools like TD AI Prism and a virtual AI assistant. I remember trying to get help from a bank's automated system once, and it was, let's just say, frustrating. Oh, what's the real game changer with these TD tools beyond the buzzwords? Are they actually enhancing the customer experience, or is this more about internal efficiency for now?
that's a great question because it's easy to get lost in the tech hype. But what we're seeing here is a dual-pronged approach. Tools like TD AI Prism are about internal productivity, allowing their teams to analyze data faster, identify trends, make better decisions. The virtual AI assistant, however, directly impacts the customer, aiming to provide more personalized, efficient service. Moving beyond those frustrating generic chatbots you mentioned. The critical takeaway here is that these focused growth areas, especially in the US and their AI investments, they're not just about immediate gains. They're about positioning the bank for long-term competitiveness. It's about future-proofing the business and enhancing that customer experience, which is, well, paramount in today's banking landscape.
Okay, so we've covered the impressive strengths and the strategic wins. But as with any major institution, there are undercurrents, challenges, and some significant strategic shifts happening that come with a price tag. One of the big ones is restructuring. TD incurred a pre-tax charge of $333 million in Q3, which is part of a larger anticipated $600 million to $700 million pre-tax over several quarters. It seems like a big number, but it's framed as an investment for long-term benefit.
Indeed. While these are substantial charges in the short term, the bank anticipates annual run rate savings of $550 million to $650 million pre-tax from these restructuring efforts. This isn't just a cost, it's a proactive strategic investment in creating a more efficient, agile operating model, positioning them to reduce expenses significantly in the years to come.
And then there's the elephant in the room for their U.S. retail segment. Ongoing anti-money laundering, or AML, remediation. The expenses for this are projected to be around USD 500 million pre-tax in both fiscal 2025 and 2026. That's $500 million a year. This isn't just fixing a few loopholes. It feels like a strategic investment to fortify their defenses and restore regulatory confidence, which is paramount for their U.S. expansion.
Right. The critical takeaway here is that these are not just challenges, but costly proactive measures TD is taking to clean up and refine its operations, particularly in the U.S. These investments, while hitting the bottom line now, are absolutely essential for long-term operational integrity and regulatory standing, crucial for any bank operating at this scale. They're actively shaping a more streamlined and compliant future for themselves.
Another big move they're making is a significant balance sheet restructuring in the U.S. Imagine TD's U.S. balance sheet as a giant garden. They're proactively weeding out $18 billion worth of underperforming or less strategic assets. Loans that aren't yielding enough, or investments that don't fit their long-term vision. This runoff or selective repricing isn't just financial jargon. It's a strategic cleanup designed to make their U.S. operations much more profitable and focused down the line.
And we also see broader economic currents influencing their strategy. Global trade dynamics and sector-specific tariffs continue to create business uncertainty and economic distortions. The bank has proactively established a $600 million reserve specifically related to these trade policy risks, demonstrating their active and cautious approach to managing external pressures.
So what does this all mean for the future? Beyond the numbers, the real pulse of TD's strategy emerges from the direct conversations with their leadership during the Q&A. Let's pull back the curtain on what they revealed when pressed on their biggest challenges and ambitions. One important question was about U.S. loan balances and when we might see an inflection point for growth. Leo Salom, the group head of U.S. retail, was quite transparent. He explained that while they do expect some contraction in the loan book through most of 2026, an inflection point is indeed anticipated towards the end of that year, with growth already visible in segments like bank card, home equity, small business, and mid-market.
That response is crucial because it gives us a clear roadmap. It acknowledges the current pressures from their restructuring efforts, but also points to specific areas where they're already seeing positive momentum, indicating a carefully managed, segmented approach to returning to overall growth. It's about targeted success, not just, waiting for a broad market recovery.
And regarding that $18 billion runoff program in the U.S., Leo Salom confirmed that this reflects the entirety of the program, integrating all previous announcements and strategic reviews. This provides clear scope and maybe a sense of finality to a complex financial maneuver.
This clarity from leadership offers a transparent look into the bank's strategy and how they plan to navigate both current challenges and future opportunities.
Yeah.
It's a critical window into their forward planning, showing commitment to a definitive course of action.
Okay. There was also an important question about the indirect costs of AML remediation and whether they were affecting other segments. Kelvin V. Tran, the CFO, clarified that the majority of year-over-year expense growth related to this is governance and control related. He noted that they're making specific systemic investments across the bank in AML, fraud, cyber, and general compliance. So it's not just one isolated issue. It's a massive institution-wide uplift in their entire control environment.
Right. That underscores the depth of their commitment to strengthening foundational operational integrity across the board. It's an investment in capabilities that will serve the entire institution, a necessary move to ensure long-term trust and regulatory standing.
Another highlight from the Q&A was about the integration of Talon and its impact on TD's investment banking mandates in the U.S. Raymond Chun, Group President, highlighted that this acquisition has successfully scaled TD's capital markets business, leading to a significant increase in revenue and enhanced capabilities in advisory and equity capital markets, particularly in the U.S. It's a clear strategic acquisition paying off.
It truly is. This acquisition expanded TD's reach and expertise in a critical market segment, and it's an example of how their long-term growth strategy is already translating into tangible revenue-generating results.
And finally, about that $600 million reserve related to trade policy risks. Ajay Bambawali, Chief Risk Officer, explained the dynamics, saying that if tariffs or global uncertainty were to decrease, the bank would reassess and potentially release part of that reserve back into their earnings. Conversely, if conditions worsen, additional provisions might be required. It shows how actively they're managing that specific risk.
It really highlights the agility required in risk management today.
Yeah.
The ability to dynamically adjust reserves based on shifting global economic conditions is a key indicator of a sophisticated risk framework. Looking ahead, you have to ponder how these strategic decisions and ongoing investments today are laying the groundwork for TD's competitive position years down the line. Despite the short-term costs, it's a continuous balancing act between current performance and future resilience.
So what does all of this mean for you, our listener? What stands out to you when you consider these facts? For me, the core understanding gained here is that TD Bank is a major financial institution executing a complex, multi-layered strategy. They are demonstrating strong financial performance in Q3, while simultaneously undergoing fundamental and costly strategic transformations. It's a story of balancing immediate investor expectations with significant long-term investments in compliance, operational efficiency, and market positioning. This deep dive provides a far richer understanding than just reading the headlines, truly showing the multifaceted, dynamic nature of modern banking.
And it illustrates a critical lesson: how a company can demonstrate robust current performance while simultaneously undergoing fundamental, often costly, strategic transformations for future resilience. It highlights the importance of looking beyond just one quarter's numbers to grasp the full strategic narrative of a major institution. It's about seeing the forest and the trees, you know?
Absolutely. Thank you for joining us on this deep dive into TD Bank's Q3 2025 earnings. Understanding the nuances of these financial reports, with both the impressive highs and the strategic heavy lifting happening behind the scenes, is truly key to being well-informed in today's fast-moving financial world.
This raises an important question for you to consider. How do you weigh a bank's strong current earnings against its significant ongoing investments in areas like restructuring and regulatory compliance? What specific long-term indicators would you look for to confirm these costly strategic shifts are truly setting TD up for sustained success in a rapidly changing global financial landscape?
Subscribe to my channel Report Stock.